Hi everyone, IGCC Accounting. Today's topic is correction of errors. While recording the transaction in the journal, posting them to the ledger account, casting, or at the time of balancing the accounts, there are chances for errors. Such errors are to be found out and corrected in the books of the business. There are two type of errors. First one is errors not affecting trial balance. The other error is errors affecting trial balance. Errors not affecting trial balance. These are the type of errors which does not affect the agreement of trial balance total. The following are the details of the those errors which do not affect the agreement of the total. Type of errors. There are six type of errors which do not affect the agreement of trial balance. First one is error of omission. A transaction is completely omitted from the book, or a bookkeeper he might forget to record the transaction in the book. For example, a purchase of goods is not recorded because the purchase invoice has been misplaced. This is a very simple one error only. A student can easily record this transaction and identify easily this transaction. The error of commission. Purchase of soil is entered in the wrong person's account. This is a wrong person's account only, but it is come under same classes of account. For example, a sale of goods to J Taylor is posted to J Taylor's account. Yeah, please students, please check this. The spelling of two customers account. One, the spelling is different. They are both are different customers. Customers are, you know, that credit customers are trade receivable only. Trade receivables are current assets. So these both are related to current assets only, trade receivables only. So same classes only. These both, you know, both are customers, credit customers, trade receivable. They both are trade receivables. Okay, and also in the case of trade payable also, credit supplies different person's account, that also belong to error of commission. And also sometime when we prepare the cash book, we may write instead of cash book, cash column, instead of cash column we write bank column. That is also error of commission only. Same classes. In the cash book, you know, cash account and, you know, bank account in the cash book, both are current assets only. Okay, it is not affecting the total current assets. Error principle. An item is entered in a completely wrong classes of account. For example, purchase of non-current asset is posted to the purchase account. Non-current asset is a statement of financial position item, and we show in the statement of financial position. But purchase is goods purchased only. This is expense of the direct expense of the business only. This comes under cost of sales, that is income statement item only. It is affecting the profit, but non-current asset is affecting the total, you know, assets of the business. So both are, you know, different classes of accounts only. Compensating errors. By coincidence, an error on the debit side cancel out an error of the same amount on the credit side. For example, the sales account is overcast by $70 and the trade receivables are also overcasted by $70. When we prepare trial balance, sales account credit sales is credit balance only and credit side is, you know, overstated by 70. The same, the debit side also overstated by 70. Trade receivable is debit balance, So what will happen means when we total is trial balance shows equal, because here sales account and trade receivables account both are overcast by 70. Fifth type of error is error of original entry. Wrong amount is entered in the book of original entry, and this figure is then used for posting to the ledger. A check for $270 received from Albert recorded in both books as 207. The check received, and it is actually undercast only, both undercasted, both debit and credit entry is undercasted 63. So both debit bank account as well as Albert account undercast by 63. Your undercast means you have to pass the same entry only. I mean, bank account is undercasted, so you have to debit bank account, and Albert account supposed to be credited. So here also you have to credit Albert account 63 undercast. If it is overcast means it will be reverse. Bank will be credited and Albert account debited. Okay. Then last type of error is error of reversal entry. It is also known as complete reversal entry. A debit entry is written on the credit side and a credit entry is written on the debit side. A cash sale is debited to sales account and credited to cash account. Cash sale. The asset increases, cash debited only, and the sales is an income. Income has credit balance only. But here, what is the mistake is it is wrongly credited the cash account and debited the sales account. So what will happen means sales account and cash account here opposite way we have recorded. So in that case, we have to write it correctly and amount should be doubled. One example question: the trial balance of Sanjay balance as at 30th June 2016. However, the following errors have been discovered in the ledger account. You have to identify type of errors. Okay. A check sent by Sanjay to Lumsans Furniture for 3,000 in settlement of goods bought on credit has been recorded in the account of Lumsons Furnishing. Here you can see that wrong classes of wrong person's account, same classes only, and the wrong person's account. In this type of transaction is error of commission only. Error of commission, same classes but wrong person's account. The second question: the cost of new delivery vehicle $10,000 bought on credit from Rana a moto has been debited to vehicle expense account. The cost of new delivery vehicle is a non-current asset and should have been debited, delivery vehicle account, but has been debited to vehicle expense account. Here expense means is income statement item only. So this type of error is called a error of principle. Total of both the purchase account return outwards account have been overcast by 1700. Purchase account is an expense has debit balance only. You have to record in the trial balance under debit side, debit column, and return outward, that is purchase return only. Purchase return is opposite of purchase, credit to balance only. Both are overcast by 1700. So it is also not affecting the trial balance, and this error is called a compensating error. Next question is you have to identify the error. Sales return of $450 from Lim Lee, a credit customer, have been ended on the wrong side of both account. Here, the wrong side of both account, instead of debit credited, instead of credit debited. Sales return. So this is error of reversal entry only. It is also known as complete reversal entry. No entry had been made for the stationery $35 paid in cash. This is error of omission